Alrighty guys, what is going up? I hope you guys are all having a great and amazing day today. Now in today's episode, we're going to be talking about beginner investing mistakes that I made when I first started out investing in the stock market. So I hope you guys enjoy it, and if you guys get anything in value, make sure you guys hit that like button and subscribe to the channel. It really helps me out, so make sure you guys hit that like button. Also, if you guys want to learn how to properly invest in the stock market, I do have a $5 course talking about fundamental analysis, technical analysis, how to find undervalued stocks, taxes, retirement, honestly, pretty much everything you guys need for investing in the stock market. It's the first link down below, so go ahead and check it out. So now to jump into it, roll the intro, let's go. Bam. Now, when I first started out investing in the stock market, I was super into day trading stocks. And yes, I still do it here and there, but not nearly as much as I used to. But the reason why I started out day trading is because I wanted to get rich quick. And with the first lesson and the first mistake that I made was investing in the stock market should not be a get rich quick scheme. You know, if you invest for the long term, you can almost guarantee profits because over the course of the entire stock market's history, it's gone up around 10% per year. And with all the recessions, all the crashes, within a couple of years, it always recovers. So now the second lesson that I had was buying hyped up stocks. Now these are going to be stocks that you hear about on Twitter, on YouTube, on pretty much any Discord chat. The reason why these stocks are so hyped up is because often these stocks are going to have a fundamental catalyst or like news or earnings, which cause that stock to absolutely explode up. And then once the market and once people realize, well, I'm overpaying for this stock, often there is going to be a little correction or a little crash in that stock. So the biggest thing, do your own research with investing in stocks. When you pick and choose, make sure you guys know almost everything about the company. Make sure you guys do fundamental analysis, which is like the balance sheet, revenue, debt, margin, stuff like that. And then you also want to look at the technical side. You know, this is going to be like support, resistance. Is it undervalued, overvalued, stuff like that. It really goes a long way. So the biggest thing, do your own research with investing in stocks. The third mistake that I made is I did not do enough education. You know, when I first started out investing, I thought I knew everything. I honestly thought I could navigate the markets and make money and just absolutely kill it. But I soon realized that I should invest into education. And this could be anything from investing into courses, this could be anything from investing into books, something that's going to give you education where you have a little edge over others. Because in the stock market, it's a dog battle. And so if you have a little edge or more education over someone, you're going to be the one that comes out profitable and the one on top. So the biggest thing with this one is make sure you guys have as much education as you can, whether it's books, courses, YouTube videos, free ebooks. Try to go the free route if you can because it'll save you guys some money. So the fourth mistake that I made was buying stocks based on their dividend yield. You know, as a dividend investor, I was super in tune to dividend yield. So me looking at a stock that pays a 7% dividend and then a stock that pays a 2% dividend, I was always kind of going towards the one with the higher yield because I thought that was a better stock. I was gonna get more cash flow, and it kind of makes sense when you think about it, but if you hear me out, often the stock that pays a higher dividend yield has a more chance to cut their dividends, and often those dividends are not going to be around for much longer. And another thing is often this stock will be declining in stock price. You want a stock that is a high quality stock, pays a 2 to 3% dividend because you know can grow, and has a payout ratio of under 60%. Those little tips and tricks right there are going to save you guys so much money and so much headache when you guys are in dividend investing. Also, make sure the dividend stock has an upward trend because often these dividend stocks are going to be going down in value and your yield is just getting higher because the stock price is falling. So make sure you guys have a stock that's going up in value and can grow in the next 10, 15, 20 years rather than it's going to be bankrupt in like 2 or 3 years. So the fifth thing that I learned investing in the stock market is diversify as much as you can. Because when you are picking and choosing different stocks, your risk is going up. So here's my little tips and tricks. If you guys can get one thing out of this video, understand this. Have a defense in your portfolio. Now, imagine this. If you guys were a football coach, would you just focus on your offense? or your defense. Now, most people would say, well, I want to focus on scoring touchdowns, but you have to have a mixture of both to win games and to win championships. And having a stock market portfolio is very similar to that. If you're always scoring touchdowns, your risk tolerance is going to be through the roof. But if you have something that's working as a defense in your portfolio, these could be anything from ETFs to bonds, something that's going to be paying you some cash flow, doesn't move as much, and on average gets around 5 to 3% per year in just growth. The reason why this is so important is because investing in stocks is very volatile. Some of these stocks are going to be going up and down at rapid rates, so it's nice to have something that's just paying you cash flow and is kind of in your portfolio as a defense. Trust me, you guys will not regret that. Now, the sixth mistake that I did was trying to beat the market. Now, when you guys are investing in stocks, everybody's trying to beat the market. Everybody's trying to beat the S&P 500 or the Dow Jones because that's like the golden standard for investing in stocks. If you can beat the S&P 500, you are a world-class investor. Warren Buffett has a historical return of around 17%, which is really good. 17% every year compounded is a ton of money. That's why he's worth billions of dollars. It's better to be in the market than out of it. If you guys are holding cash on the side and you're trying to figure out a good opportunity to buy in, it's better to just be in than out. Another thing, all those people who invested in 2007, 2006, 2008, 2009, all the times where the ground was unshaky or overvalued or undervalued, they're profitable now. So it's just a thing where you have to look towards the long term and realize that it's better to be in than out of it. Because over the course of 50 or 60 years, since the S&P 500 has been around, it's had an annual return rate of around 10%. And that's going through the Great Depression, that's going through the dot-com bubble, that's going through the 2008 crash, and now the 2020 recession. So just look for the long term and you guys will be alright, I promise. Now, the seventh mistake that I made was not understanding fees. Now, this is super important whether it's a broker that's going to be charging you fees or ETFs or mutual funds. Now, mutual funds, in my opinion, no one should buy because they're too expensive. You have a load fee of 2% when you first start off, then you have an actively management fee, and then you have an expense ratio fee, and then you have a tax fee. It's just a terrible thing. If you have an ETF, it's not as bad. It's around 0.04%, which in the grand scheme of things is not much at all. And then make sure your broker is not charging you money. That's the biggest thing. Try to figure out a commission-free broker. There's a ton of them out there now. Robinhood, M1 Finance, Webull, Moomoo. There's a lot of them. So make sure you're not getting charged any fees with your broker and your investments. And if you are getting charged fees, make sure they're as minimal as possible. My rule is under 1%. If they're charging you anything over 1% per year, it's not worth it because you can go to a better broker or you can go to a better ETF or anything. Any investment should be under 1%. So the eighth mistake that I made was using margin. Margin is like the broker's money. It's often known as leverage in the stock market. And this is really a terrible thing because the broker is going to charge you interest to use that money. And then if your investment doesn't pan out, you're going to still have to owe back that money to your broker. It's not worth the headache, not worth the time. So never use somebody else's money to invest in stocks. Stocks are risky and yes, can go up in value, but they also can go down. So you never want to get stuck holding the bag with other people's money. So those were all the mistakes that I made when I first started out investing in the stock market. I hope you guys got something in value out of this video. And if you did, make sure you guys hit that like button and subscribe to the channel. It really, really helps me out. So we'll see you guys tomorrow in another episode. Remember to stay happy, stay positive, and overall, stay safe out there. We'll see you tomorrow. Take care. Have a good one, guys. Bye.